everyone, welcome back to my channel. Okay y'all, so today's video is focused on stocks that provide a high yield return. So I'll go over a few companies that pay out high dividends and are currently at a pretty decent ROE. But I do want to mention before we dive into it, most of the companies that I'll discuss do not have the best overall fundamentals, and y'all will see that. So this is more so an analysis of stocks that will help you generate income based on your investment, not necessarily the growth rates or the company's profitability itself. So I'll cover some popular and a few not so popular high yield stocks. So let's just go ahead and jump right into it. So y'all can see I have Chevron pulled up here under the Analyze tab in Thinkorswim, and we can currently see that Chevron is trading for $160.60. So I'm going to go ahead and scroll past the overview and of course the company profile, and we're going to go ahead and take a look at by the numbers. Now, as mentioned, I'm going to focus mainly on the return on equity because this is so important when considering profit margins. And that's just attributed to the fact that a high ROE helps to boost the capital gains. Okay, so of course we know that Chevron is in the energy and oil sector, and we can see that the numbers are actually not great when we look at quarter over quarter. It is at a negative 37.8 when we look at the EPS, and this is for the trailing 12 months. However, when we take a look at the dividends per share for the TTM, it's currently at $1.71. Now that may not seem like much to new traders. However, if you're an investor who's been doing this for a while, you'll definitely know that that's a high number and it's pretty significant. Now when we take a look at the ROE, we can see it currently at 6.76 and the dividend yield is at 4.6%. Now Chevron is obviously a company that has high dividend reliability with decades-long history of increases. And this being added to the integration of it being in the energy sector, this business model provides a lot of stability, I will say, and then across exploration, the production, and refining. Now, clearly we see the growth rates are not that good. Their revenue is currently down. We see the net income as well, and then also the EPS. However, the dividends per share have relatively remained the same over the last 3 to 5 year comparisons. And this is also tied in with the strong ESG improvement and investments in cleaner energy options we know have been taken advantage of as well. So because of that, Chevron is positioned for long-term income and modest capital appreciation. So while it's not the best company as far as the numbers are concerned with growth rates, we can't ignore the fact that the dividend yield is pretty high. Now, would this be worth investing for some people when they look at these numbers and understand the fact that they are negative as far as QOQ? For some, the answer would be no. However, if you are one that is more concerned with the actual payout of a dividend, then this may be more so suitable for your style of investing. So it's just all dependent on the person. Now, Chevron's share price is currently $160, but if you did want a cheaper alternative within the same sector, you can take a look at ExxonMobil, which we'll discuss next. And we can see that this stock is currently trading for $114.29. So scrolling past the overview and company profile, we're going to go ahead and take a look at by the numbers. So the first thing we see here is, of course, the EPS is currently in the negatives as well for QOQ, with it currently being at $1.64. And the dividends per share for the trailing 12 months is at 99 cents. Now with that, we also see the return on equity, the ROE, is at 10.89. And this reflects strong cash flow generation, which supports consistent dividend payouts, which we can clearly see here the dividend yield is at 3.6. Now, ExxonMobil's global presence with, of course, diversified oil and gas operations, it basically is reducing the reliance on a single market. So that's important to keep in mind. Now, their balance sheet and history of weathering commodity price fluctuations, it is up and down. We can clearly see the growth rates are also negative. So, of course, the fluctuations are going to be hit or miss. We can see the comparisons have been, again, up and down. But what has remained a positive is the dividends per share. Now, if nothing else, this is attractive for income investors looking for exposure to energy without the extreme volatility. Because the main strength of these two stocks, Exxon and of course CVX, is going to be the cyclical nature of both of them. They both have high dividend payouts, and of course they offer those energy upswings. But the major risk that goes with that is that the oil price volatility can drag down income streams. So you pretty much have to weigh the pros and cons based on your style of investing. Now, of course, we do know that both are dividend aristocrats on their way to becoming dividend kings in the coming years. So while the numbers may not look great and we don't see a whole bunch of profitability here, they do offer a pretty high dividend yield. which is helpful if you're trying to set up a portfolio that's strictly dedicated to dividend reinvestment or if you just want those high payouts. Okay, so next on the list is going to be a stock that I'm not a huge fan of. However, if we're sticking to the consistency of this video, we got to talk about AT&T, y'all. So of course we know it's under the telecom sector. Now their EPS QOQ is at 1.55%, and their current dividends per share for the TTM is at 28 cents. They have a pretty high return on equity at 15.85, and their dividend yield is at a 3.85%. Now, one of the reasons why AT&T is so popular is that it's a long-standing company with consistent payouts because the yield of the dividend is so high among blue chip companies. But the main drawback with AT&T is clearly going to be the fact that they have limited capital appreciation. And what ties in directly with that is the fact that they're heavily debt loaded. So again, pros and cons on both sides. If you're seeking a high dividend, this may be a company you decide is worth the risk. If not, then this may not be a good company for you to choose. Because while the benefits of it having a long history of paying stable dividends is appealing for income-focused investors, and of course we know there's a large stable customer base in wireless and of course broadband services, this dictates a lot of customer loyalty. And then I also can highlight the fact that it is a defensive sector type stock because telecom demand remains consistent regardless of economic cycles. So in a way that does make it attractive for investors seeking reliable cash flow, but that moderate growth potential could be a hindrance to those who are seeking to invest. Now, kind of following in the same pattern with this, we're also going to take a look at Verizon. Now, Verizon's share price is currently trading for $44.23, and I'll go ahead and scroll down so we can take a look at the numbers. Again, very similar to the same thing we would see with AT&T, not the best quarter over quarter. However, their dividends per share for the trailing 12 months is at 68 cents, ROE is at 19.84, with a dividend yield of 6.2%. Now, because the market is saturated with this, we are going to see some differences in, of course, the growth rates in comparison to the 3-year and the 5-year average. So fundamentally, they're not the best, but definitely one to keep in mind and put on this list for dividends. Okay, so y'all, this next stock that I'm going to discuss is one that I didn't even think I wanted to bring up in this video just because the numbers were so terrible, but I'm going to go ahead and pull it up anyway. It's going to be NLY, and I'm sure y'all have heard of this REIT. It's currently trading for $21.19. Not one I'm a huge fan of, but definitely one I wanted to mention if we're just strictly looking at a high yield return. Now, what stands out as the most obvious is that their EPS is at a negative 394%. Clearly not great at all. We can also see their return on equity is at a negative 122.35%, which again is clearly a major concern. Their dividends per share for the trailing 12 months is at 70 cents, but amongst all of this, the major standout is that the dividend yield is at 14.34. Now, this is an extremely high dividend yield for income-focused portfolio investors. Now, this company is specialized in mortgage-backed securities and is benefiting from interest rate spreads. So it's definitely possible with this stock to add some diversification outside of traditional equities because it is a strong option for investors seeking current income rather than aggressive growth. Now, certainly this mortgage REIT is known for the sky-high yield we can see. However, I will say be very cautious when you're taking a look at this investment because rate sensitivity is the main thing to keep in mind with any REIT. Because a rise in interest rates hurts profitability, and we can clearly see that when we look at their net income at a negative 242.39, which means the company has gotten progressively worse over the last 3 and 5 years. So now I'm sure y'all see why I didn't want to necessarily mention this stock in this video, but I just didn't want to leave it out strictly based on the return on investment. Okay, so the next stock I do want to bring up is going to be SKT. And if you've been on my channel for a while, you know that I've mentioned this stock several times. But for anyone who's new, SKT is also going to be a REIT, and it's actually focused on outlet malls and retail shopping. Now, I will say it's one that's not super popular. It's currently trading for $34.18 for the share price. And when we take a look at the numbers, they are pretty decent. Dividends per share is currently at 29 cents. The return on equity is currently at 18.96. And then the dividend yield is at 3.7%. The growth rates, of course, have been a little bit up and down, we can see here, but definitely a lot better than others on this list. I do want to mention that when structuring investments for the best results, blue chip stocks like AT&T, Exxon, and Verizon I mentioned, those are going to be a good approach to take in combination with a stock like SKT because you can build your base portfolio with these as anchors. You can buy consistently and reinvest the dividends. A downside to that is that the risk to reward is going to be lower growth but stable payouts. And this works well for buy and hold, or if you wanted to do like covered call option strategies on some of these, you could if you wanted to. Also, another good thing to pay attention to is the cyclical stocks. I'll say the main one that you should look at for this is going to be like ExxonMobil and Chevron. And a good approach is to time your entries around economic cycles. So use leaps when prices are near sector lows. And just keep in mind that one of the risk to reward drawbacks for this is going to be the high upside in up cycles, but dividends can fluctuate. Now, the last thing I wanted to mention in this video is that when you're looking at the growth rates of any stock, remember that you want to set your investments up to be as best they can to be the income core, and dollar cost averaging works well, especially if you're just starting out. So you can layer in strategies for entry at lower prices, and those two combinations can help protect you during downturns like recessions. So dividend plays have to be really strategic. You can build your drip with long-term compounding, and this can outperform growth stocks over decades. It can take time, but again, it would be worth the risk if you're one that sees the value in doing so. Now, I'm never one to recommend stocks that are always in the negatives, simply because it's not always about the money and the payouts. But when you're considering your R&R, watch for rate cuts, which is one of the biggest risks in chasing high yields. Now, of course, growth stocks with dividends are going to have a hybrid strategy that you can develop, and this is usually great for pairing with long equity with option spreads, and y'all have heard me talk about that countless times. So a good takeaway is to have a strong balance between dividends and appreciation. And that way, with this approach, even when they're speculative, high yield, some stocks you can keep as a smaller percentage of your portfolio, maybe like 5 to 10%, and you can use these options sparingly. And this is super useful because we know that anything above a 3.5% for the dividend yield is considered pretty high. But be cautionary to the fact that big payouts can be fragile if rates shift, because there's so many factors that go into it with economic changes. So the best way to go about it, especially if you're a new investor, is to choose certain categories. Some can be beginner friendly, and that means it's best to start with names that are dividend kings or at least aristocrats, because the dividends keep paying while you're still learning to time your entries. And that consistency can mitigate mistakes. Now, when you're growing and you're learning as a trader, you can understand market cycles, and then you'll then be able to benefit from rotating into different tickers or be more selective with midstream stocks. And then only once your risk tolerance is built, you should step into plays that have a higher risk associated, because while the payout looks attractive, it can quickly go left. So just make sure to take your time when investing. I would also recommend always take a look at the gross profit margin, because this can be very telling, especially for investments that you're unsure about. Now, why this stands out for high profitability is because you want to link together the dividend reliability plus the capital appreciation. Because oftentimes what we don't discuss is that the strongest profits don't come from the highest yield. They come from consistent dividend stocks that also have growth potential. Now, clearly I've been talking about investing, but if you're options trading, high yield names often have lower volatility, making them ideal for covered calls or even like cash secured puts, because all the while the dividend provides room against option premium decay. And I can make a whole separate video about that if needed. And lastly, if you're strictly looking for long-term investing, I'll leave a link to a few videos where I discuss some of these stocks below, because over time they outperform growth-only stocks, because more true is that high-yield stocks allow you to get paid to wait because the yield compounds even during market stagnation. On the other hand, while holding shares, you're allowing time to accumulate price appreciation because the stock itself funds your account growth every quarter. So that'll always be the best benefit. So yeah, y'all, for the most part, that's really all I wanted to discuss, and that'll pretty much do it for this video. I hope this does help put things in perspective. So if you found any of this information to be helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching, and of course, I'll see y'all in my next one.